Ladies and gents, welcome back. I'm wearing my headphones today because we're going to be reviewing some video here. I want to bring attention to the housing market in Canada. Now, this has been a bit of a passion of mine, talking about and well, reading and looking into economics and markets and how they operate. It has been since there was a giant crash. Maybe you don't remember it, but it happened in the United States in 2008. In Canada, we largely were able to avoid that crash because of our fiscal policy that we had at the time under the conservative leadership of Stephen Harper. Now, a lot of people did not like Harper and voted him out. Ever since then, our fiscal policy has been that of a drunken sailor. Now, I want to show you some of this information as we're going in, just to preface what's been going on. So I have a graph here that I was just quickly able to just pull up on Google. This only goes to 2016, but this shows United States housing prices as compared to Canadian housing prices. Now, housing prices were, a bit in fluctuation all over the place in these times. We can see particular dates here where this was all happening. We see here at the end of 2007, that's when the U.S. market dropped out dramatically and did so for quite a few years before rebounding a bit. And that may be due to their fiscal policy as well. Canadian market, it looks like the exponential hockey stick graph that you typically see when people are alarmed about something. Yeah, maybe this has something to do with the alarm, but mind you, this only goes to 2016. The housing market has been going even crazier ever since then. We have here a report from Wawa, Canada, real estate. The average sold price in Canada, and this is across all the provinces, including none of it, people are buying houses for a lot of money up there, apparently. This 748,000 ridiculous price for a home, average price in Canada, up 20% year over, and this is compared to January 2021. The prices are shooting up exponentially, and not all of this can be accounted for through inflation. A lot of it is policy that is putting people into mortgages that, well, let's just say, probably can't afford if market rates change. Now, we look back at times back in the 1980s when market rates adjusted. And I'm talking about interest rates here in the 1980s under Alan Greenspan, I believe it was, at the Federal Reserve in the United States. Now, what happens in the United States happens to Canada. Our dollars are pretty much pegged to each other. The Canadian government does what they can with their central bank, because the Canadian economy is run by a government-run bank. And what they do in their fiscal policy is pretty much just tail behind the United States dollar in the hopes that we can foster trade by having our dollar just slightly below the value of the American dollar. Now, if you contest that opinion, you know where to put it, down in the description down below. I'll read in the comments below. I'll read your comments, and I'm happy to have discussions on this type of stuff. But what took me by surprise, actually, was somebody speaking about this in a logical sense, and that would be recently we had Pierre Poilievre of the Conservative government grueling some of the members here, and let's just dive into it, because this is something to behold.
What is the total dollar value of insurance in force at the CMHC? Just the number, please.
And it takes a moment for them to get back to the number.
So currently, our insurance in force is. And
don't worry, he'll get into what the CMHC does, so I don't have to explain this now.
I don't need to get that. It's $404 billion.
And then, what is the total value of guarantees under the National Housing Act, mortgage-backed securities, and Canada mortgage bonds? The total, please, the number.
The total is 460.
So if you add those two numbers up, 404 plus $460 billion, I get $864 billion. Is that the total value of the amount of money the government is on the hook for when it comes to backing up mortgages?
So thank you, Chair, and just in response to Mr. Poilievre's question, the reason I hesitated when he first asked the question is
right. We don't have a lot of time.
I know those two numbers.
We don't have a lot of time to pay it back
because some of the mortgages are in the securitization.
I know that, Ms. Powers. But what I'm asking for, what is the total number? And what I did ask you for the first time is, what is the total number when you remove the duplication?
So I don't have that number on hand, but we can certainly get that.
That is very disappointing because we're talking about hundreds of billions of dollars of
yeah, just before we get into it, so what he's referring to here is essentially for my American viewing audience that's familiar with this situation. So you can compare this to Fannie Mae and Freddie Mac. So like the state entities that backed mortgages. So if people were not able to pay, like if they were to default on their mortgages, the banks were guaranteed payment from the government for these entities in order to foster an economy where people would buy these houses, because otherwise lenders would not lend out the money for this, given risk assessment on whether or not someone could pay back a loan in this regard. So when he's talking about these securities, he's talking about, or the guarantees that the government's on the hook for if in the case people default on their loans. Now, a lot of realtors are looking at this, and you'll hear this from realtors. The market since the Great Depression has never gone down. It only goes up. Why would it ever go down? Well, that was the argument in 2006 for the housing market in the United States, and that, of course, we can see here did actually go down. But I'll let them continue in this.
Yeah, point of order.
Liability.
Point of order.
Yes.
Point of order.
This way of questioning, to me, make me uncomfortable in front of our witness. I'd like Mr. Poilievre to be a tiny bit more respectful towards our witness, please.
With all due respect, I'd like the government to be more respectful towards the coffers that they're responsible with. Just putting my 2 cents out there. This is our money as Canadian taxpayers that's on the line here in this given situation.
Okay. We have talked about respect and decorum, Mr. Poilievre, but and just crosstalk. So for the interpreter's sake, so let's try to just stop that. That'd be great. Thank you.
Well, it makes me uncomfortable that we have hundreds of billions of dollars of unknown contingent liabilities. Ms. Romy, if people do default on their mortgages, your corporation then pays the default loss to the bank, and taxpayers could be on the hook for that money. And the fact that you don't know the total amount of guarantees that your government, that your organization is offering on behalf of taxpayers to our banks is problematic. I'll explain why. If our housing prices simply went back to the level they were at in 2020, that would be nearly a 25% reduction in house prices. And if people went defaulted on those houses, many would be underwater. So taxpayers would then have to pay for the default loss. And I would expect that the head of the corporation that is managing these liabilities and this risk for taxpayers would know the number and have them at fingertip. And I want to go to Mr. Rutledge now to further talk about the risk. What percentage of new mortgages in last year were variable rate?
Okay, so before we get into this, a little discussion on what variable rate mortgages are for people who don't understand what that is. So you have typically fixed rate mortgages where you get into a mortgage, the bank will give you a fixed rate, maybe a little bit higher above market value for the interest rate, but you'll get locked in for a set amount of time, say 10 years or whatever, 5 years, and that'll be a fixed rate until your mortgage adjusts down the road. variable rate is a way to keep the rates low in a marketplace where we have such very extremely low interest rates. Here we have the market rates here, so 1.2%. These are ridiculously low interest rates. Like, you have no idea. It's just, crazy. So a variable rate would give you the benefit of having these very, very low rates, as opposed to having like a slightly higher rate that would be locked in. But the bank's taking the risk on where the rate goes if you go that way. Now, if you have a variable rate, you're taking all the risk on what the market's going to do. And as I was referring to back in the 1980s under Alan Greenspan, the markets had to adjust and interest rates went up in excess of 20%. Like, this is not a joke. 20%, nobody would be able to pay back that kind of rate. And I mean, it's higher than that would be like putting your house on your credit card. It's absurd. Anyway, I'm just going to keep going with this.
A roughly 51 or 52%.
That's an unusually high share, isn't it?
It is unusually high,
so when rates rise, those people are immediately going to have higher payments, aren't they?
Again, in excess of 50% of new mortgages in the market. Now, you have to understand, people are flipping their houses all the time. So there's a lot of new mortgages in the market, of people refinancing, all that stuff. So 50% of that being variable rate puts a lot of people at risk if the interest rates go up tomorrow.
Mr. Chair, you're right. That is a correct statement.
And what percentage of households who've got mortgages in the last year have 5% down?
What percent of mortgages, Mr. Chair, have 5% down?
Yeah, a down payment of 5%.
I would have to look into that and come back to the committee, and I will do so.
And when you do make a 5% down payment, you have to pay mortgage insurance to CMHC or the other providers, and that is tacked onto the value of the mortgage, isn't it?
Typically, yes.
Yes. So that 5%, for a 5% down, you have to pay 4% in mortgage insurance fees, which means that once you subtract the mortgage insurance from your down payment, you actually only have 1% net equity in your house then, don't you?
All else equal, everyone's different, and I wouldn't make a broad
so if someone's got
point of order, Mr. Chair. Point of order, Mr. Chair.
Point of order.
Why the Liberals don't want
point
these
of order.
Asked.
Point of order. Point of order, Ms. Zarowicz.
I can understand why these Liberals don't want these questions asked.
There's a point of order, Ms. Poilievre. Yeah, Ms. Zarowicz.
I actually think these questions are very important, but I also think the answers are very important. And I feel like Mr. Rutledge isn't allowed to actually fully answer the question. So I would ask that he be allowed to do so.
No, I
have been taking timings here, and Mr. Poilievre had 14 seconds.
Yeah, okay, so they get into semantics about the exact amount of time each person's allowed to speak, which is funny because this is Canadian politics and this is how it goes. It goes to conjecture rather than substance. So he goes on for a decent amount of time about that, and then we get back to
witnesses to answer those questions.
Fair point. I do want to thank Mr. Rutledge because he has actually been offering direct answers to the questions.
That's correct.
And so if you've ultimately got 1% net equity in your house, and house prices go back just to 2020 levels, so we're just talking going back to where they were a couple of years ago, and they've dropped by 25% then. You're 24 percentage points underwater in your mortgage.
Negative equity, yeah.
Now, if you can't make your mortgage payments because you're on a variable rate, you've just acknowledged that half of new mortgages are variable, and you default, then you hand your house over to the bank in a 24% loss position, and the bank hands the bill over to Ms. Bowers over at CMHC, who then passes it on to taxpayers in the form of mortgage insurance payment. That is the risk that we're facing now. I want to know what immediate action, Mr. Rutledge, you're taking
Mr. Poilievre,
to address the high level of variable rate mortgages.
We have gone well over your time, Mr. Poilievre.
Yeah, we've gone over your time, so you can't speak to this anymore. We're not going to answer your question. That's the Canadian housing market in a nutshell at the moment. We're essentially in the position that the United States or majority, like California was in at the end of 2007. That's currently where we're at. People are over leveraged. If there is a market adjustment, which they've been calling for, the Federal Reserve has been talking for too long about easing, what they call quantitative easing. Easing the easing. They're tightening up on printing more money, essentially. Now, when that happens, interest rates go up. So as the markets adjust, interest rates go up. When there's a tightening in the market, interest rates go up, and that could be a trigger for a lot of people not being able to pay the current debts that they have now, because these have been backed by securities by the government. The government is the one ultimately that's on the hook. And a lot of people were angry in 2008 when the banks all got bailed out. Now, the bailout was actually the deal that they had in the first place. The deal was, if people default on these loans, the government will pay it back. And that's what was happening in the United States. And that is currently what's happening in this now. I've been going on too long about this. If you guys want to see more content talking about the housing market, because this is another passion of mine, let me know in the comments down below, and we'll talk more about this. Otherwise, keep on trucking.